due by date, unscheduled, scheduled events. Some of our indicators that we use will give us clues as to an event happening or being due to happen. And in a sense, they're unscheduled, but they happen on regular occurrences. Earnings expiration setup. If earnings are just prior to expiration, right, you're going to have the most leverage in your options. Ramifications of events. There's expectations on earnings. Are they met? Are they unmet? Are they off the chart? Analysts predict what the earnings should be. Are these predictions, do they meet or beat? Are they make or break? Here's a chart of Google. July of 2011, they released the earnings. The stock went from $530 a share to almost $600 a share in one day. Here's Travelzoo. It went from over $85 a share to under $60 a share. 34% in one day, all because of earnings. Now, here's an option on General Electric. They missed their earnings. GE was down over 4%. An option went from 18 cents to 71 cents, 400% overnight. Here's Cisco. Again, on earnings. An option closed at 9 cents one day, and the next day it opened at 49 cents and then traded to over $1. Here's Baidu, $1.50 before earnings, over $4 after earnings. Netflix, 400% on this option overnight as the earnings came in. Google, from 92 cents to $20.20. I have a student sent me an email. He made $9,000 on this very earnings announcement. Again, empathy earnings. Home Depot, Lowe's, how about Foot Locker and Finish Line? Here we see Foot Locker. We had an option close at 10 cents, open the next day at 40, go up to 75 cents. Now, their competitor moved right along with them. An option went from 15 cents to 70 cents, even though Finish Line didn't have earnings at that same time. It moved in empathy. There's a correlation between competitors. Pay attention. It works best at or near expiration. The neat thing about empathy gamma is that quite often when a company releases earnings, their implied volatility goes way high and the options become expensive. And quite often the competitors' options are much cheaper. And we might have a chance to react, know companies and know their competitors. Now, earnings bounce back. This is FNSR. I was in this trade. We had this option close at $3.40, and then it went down to 20 cents the next day because of bad earnings. The earnings crushed the company. It crushed the call option, but the stock bounced back. The graph I showed you from Travelzoo earlier, it bounced back. We had Netflix in July of 2011, had bad earnings, but within 2 days it was higher. Not higher than before the earnings, but higher than after the earnings. It's a setup. Now we're going from company-specific events to market-wide events. My favorite is the FOMC. This is the Federal Open Market Committee. This is where the Fed, or the Federal Reserve, decides whether they're going to raise interest rates, lower interest rates, or keep them the same. This is being filmed in 2011. The interest rates are 0 to 25 basis points. 0 to 1/4%. You might be dusting off this DVD in 2014, 2018. Interest rates are going to be different. It doesn't matter what the rates are, it's that there's a change in the rates. And if there's a non-change in the rates, it's the big change in the market comes if the change or non-change is different than what's being expected. The FOMC meetings are held 8 times a year. They're published well in advance. Here's the calendar for 2012. Now you'll notice a few things. One, they're about every 6 weeks apart. 2, some meetings are 2 days long, some meetings are 1 day long. Here's the rule of thumb. If it's a 1-day meeting, it's on a Tuesday. If it's a 2-day meeting, it's on a Tuesday and Wednesday. They will make the announcement after 2 o'clock Eastern Time on the last day of the meeting. You can schedule this in advance, right? Specifically, it's usually 2:15 plus or minus a few minutes. And quite often, it's not the rate change, but it's the commentaries that come out with the rate change. This creates a setup. We are looking for gamma in our options. We're looking for an option to go from out of the money to in the money, or from in the money to more in the money. And how we're doing it is to get an above average move in the stock's price in a short period of time. The FOMC announcement generally causes a move in one direction, either up or down, above a normal day. Now the reality of options, their price like every day is equal to every other day with the possible exception of earnings. Right? And the market as a whole, it undervalues FOMC days. So we find them a great day to trade. Now the FOMC announcement generally will cause a spike, not just a trend in one direction, but it'll cause movement in a direction, either direction, up or down, that's followed by movement in the opposite direction. Here's a graph. Here's the Dow. You see the red line represents the previous close. It opens near the previous close, goes slightly sideways until 2:15 Eastern, when the FOMC announcement comes out and the market spikes much higher. Well, I say spike because it came down. A spike needs a move up and a move down. If the market would just continue up, I would say it rallies from here. But my experience, and therefore your experience, if you're willing to accept it, is that the FOMC generally causes spikes. So here's the gold miner index on an FOMC day. Again, the red line represents the previous close. It opened a little lower than the previous close and sold off until 2:15 Eastern. And it spiked back up, closing within 50 cents of the previous close. Great trading opportunity. Right? The nice thing about trading FOMC is that calls and puts may both make big returns, big one-day returns. When I mean big, I mean triple-digit big. Here is silver on an FOMC day. We see the option opened at 21 cents, and then it almost tripled by the end of the day. This is the 43 put on FOMC day. Here's the call on the same day. From the open, it more than triples, and from the low, it goes up over 600%. Think about that. You could have bought both the put and the call to find big movement. It's just a timing thing. Here's an email from a student of mine. I'll let you read what he says. Bottom line is the bottom line. He made 107% profit. Maybe better than the FOMC meeting is 3 weeks after It's the minutes. Understand, the FOMC will make a rate announcement and a statement. 3 weeks later, the FOMC will give great details on what was said at the meeting and how they came to their conclusion. I find this more often than not a better trading time than the FOMC itself. Here's volatility on the July FOMC minutes. We can see that the stock gapped a little higher, bounced around, and near the announcement of the minutes was kind of flat, and then it sold off and then rallied. We call that a spike. It just might not look like a spike because it went in the opposite direction. Here's GDX on minutes day. We have an option that opens at 22 cents, trades down to 19 cents before going to $1.12. That's 500% in one day. 500% in one day that was scheduled over a year in advance. I'm going to say that one more time. Those of you that want to quit your job, don't quit your job. Take a day off. Well, don't take a day off. Take a long lunch. This day is scheduled months in advance. We have the FOMC meeting well over a year in advance, and the minutes are 3 weeks later. That's the beauty of the government. Right? A lot of people might not appreciate what they do, but the government is pretty consistent on giving reports. They're pre-scheduled. They're giving statistics to see if there's a big change. And again, it's not necessarily the event but it's the ramifications of that event. As example, the government will give out unemployment numbers, housing sales, housing starts, consumer confidence, trade deficits, gross domestic product. Well, the government also has their hands in things trying to fix things. They might do quantitative easing, which is printing more money, which creates a weaker dollar. There's a lot of events to consider. But the point behind them is that certain days have a higher likelihood of generating excessive returns, and many of these days, if not most of these days, can be known well in advance. Use this knowledge, combine it with the appropriate strategies, and you should generate extra returns. Again, I say don't quit your day job, but do know when to take a day off. And you know what? If you do this well, maybe you can quit your day job, because trading events can generate excessive returns like clockwork.